All right. Thanks everyone for joining. We're going to give people 2 minutes to join before we get started. In the meantime, let us know where you're joining from. I think so far with the host, we have kind of 3 corner points of the U.S. covered, or the 3 coasts covered between New York, California, Miami. So let us know where you're joining from. I guess, Max, what's the weather in Miami right now?
It is about 85 and humid. It turns pretty quick from being very nice to
Miami summer.
Summer is approaching, yes.
Got it. Newport Beach, right in Peter's backyard. I assume it's generally pretty nice there.
Yeah, I'm in LA.
Oh yeah, a little bit more.
Yeah, no, I mean it's probably 70 degrees and sunny.
How about New York?
We I think we're back at 50. We hit 75 this weekend, and then we're back at 50. I wore my jacket for my morning walk with the dog. But for folks joining, we'll give people another minute or 2 to join before we get started. But yeah, we got cold again. I'm just checking the. Yeah, it feels like it's 49, but feels like 37, according to.
It's tough.
Yeah. Part of you see the impetus for coming to Miami. All right, perfect. We're gonna get started. So first of all, thanks for everyone joining. Today we're going to talk about, it's an interesting topic that you don't hear a lot about. It's about how to think about asset allocation, really optimizing asset allocation and asset location. You hear a lot about asset allocation, but we're going to talk about how those things work together. And really, this is focused on people, on high net worth individuals and high net worth families. And really, if you're facing or likely to face gift and estate taxes. We'll get deeper into that. Before we get started, fortunate to have Max joining us. Do you want to give a quick introduction of yourself and your background, Max?
Yeah, thank you. And thanks for having me, and excited to be here and spending time with everybody that I don't see, but I'm sure are listening. I'm a private wealth advisor at UBS. Our team sits between New York and Miami. We manage a couple $1 billion in client assets. We work with about 100 to 125 clients and families, all dealing with a lot of the same challenges that we're going to talk about today. So I'm excited to be here, and happy to answer whatever questions people have as we go through it, and try and provide honest, transparent, thoughts and feedback.
Awesome. Excited to have you here. Peter, do you want to give a quick background on yourself?
Yeah. So my name's Peter. I am the head of estate planning at Valur. I'm a trust and estates attorney by background. I joined Valur beginning of 2024, and I work on a lot of the estate tax strategies here at Valur.
So I'm Monty. I founded Valur. I'm not quite as sophisticated, educated as these two. So I started this a lot to help better understand the space. I worked for a startup that IPO'd, which was really trying to figure out how do I think through some of these questions and really maximize my wealth. And started Valur with the idea of how do we make this space more transparent versus opaque and make it easy to understand, utilize, and access these solutions. So a lot of what we build is technology to set up these structures at no cost and help people administer and manage them. And really the whole idea is how do we help everyone benefit from a lot of these structures and benefits that are there, so people can build wealth more efficiently. So key things we're going to talk about today are, what is the gift and estate tax? We'll briefly talk about that. Really, this webinar is focused on people who are facing or likely to face the gift and estate tax, and then really understand what is asset allocation versus asset location. And then we'll dive into some of these things of what is asset allocation, what are some of the types of asset classes, dive into what are asset locations, or essentially some of the tax advantage structures, and then really kind of understand where it makes sense, how these assets fit together with these structures to really maximize your wealth over the long time horizon. So Getting started, Peter, I guess at kind of just a high level, what are gift and estate taxes?
Yeah, so there's two different taxes, but they're sort of part of a single integrated system of federal transfer taxation. So there's the estate tax, which a lot of people are familiar with, which is a 40% tax that applies to all the assets that you own when you die above this lifetime exclusion amount, which is currently $13.99 million. And so if you died with $20 million and you hadn't used any of your lifetime exclusion amount, you'd be taxed at 40%, or your estate would be taxed at 40% on the excess $6 million. And so that would be 6 million times 40%, so about $2.4 million of estate tax liability. The gift tax is sort of the sibling of the estate tax. It applies to gifts that you make while you're alive to other people. And so you also have a $13.99 million lifetime exemption amount from gift tax. And so if you gift less than $14 million during your lifetime, you won't owe any gift tax, but you'll use up some portion of your lifetime exemption amount, and so that'll subtract from the estate tax exemption that you have when you die. So if you use $10 million of gift tax exemption, you only have $4 million of estate tax exemption left over when you die, at least under current law. And so it's sort of a helpful context because a lot of high net worth people either already have trusts or are thinking about setting up trusts, and gift and estate tax is always in the background.
Yeah, and it's a really important thing, and this is where it's, I think, like most financial planning, doing things earlier versus later has a lot of benefits here. But that's kind of the basics. Now, maybe we're going to jump into a key premise of this webinar is thinking about asset allocation and asset location. I think people are more familiar with what is asset allocation, and really it's a type of different assets you invest in. So common things you hear about are, public equities. So this is everything from Apple stock to public market ETFs, to another category is bonds. So treasuries is another category, or debt. Private equities is another category. It's really different asset classes, and the idea is these all have different risk, return profiles, time horizons, and liquidity. And then there's location. This is essentially the type of account that owns the asset. And common things that people are familiar with are retirement accounts. For instance, IRAs, Roth IRAs, those have tax advantages. But there are other structures, and this is particularly if you're worried about gift and estate taxes. These become really critical to avoid, as Peter mentioned, gift and estate taxes or capital gain taxes. These structures have different benefits. And they work with these different types of assets in different ways. So I guess, Max, want to kind of dive into, how do you think about asset allocation of, if you have X dollars, how do you think about where you invest that and the different types of assets you invest in?
Yeah, I think, as you alluded to, a lot of people, I would imagine, are familiar with asset allocation. And the way I like to think about it, and the analogy I tend to use, is once you figure out your risk profile, your time horizon, and really that second bullet there, your need for liquidity. The way we really think about it is from a 30,000 foot view. If you're in a plane, starting at the very top, it's the very high level asset classes. So you're talking about cash, fixed income, equities, and alternative investments. And as you kind of get lower to the ground, those break out into subcategories and even further than that. So perfect example is equities. So within equities, you have both domestic US equities, you have international equities. Within, I'll just keep going, a step lower. Within US equities, you have large cap equities, you have mid cap, you have small cap. And within that, you have core, value, growth assets. So really, as you get lower and lower and more granular, you then, from a bottoms up, the way I like to think about it, the actual asset selection, whether that's Apple stock, as you mentioned, or private equity vehicle, or whatever that might be, that's ultimately how you fill in from a top down, the specific asset classes that you, based on your risk and your return expectation, really are looking to achieve. I think, and I say this to clients a lot, one of the things that you can control is how you're allocated. You can't a lot of times control the underlying performance of particular asset classes, but you can control the fact that you own 40% in equities, and of that, 75% of it's US equities. You can't really control how US equities do, but by controlling the asset allocation, you're ultimately controlling your level of risk based on historical assumptions and how specific asset classes have performed over time. I think the third bullet there really does a good job of painting the picture of, okay, we have our top down, how we want to allocate, right? 30% fixed income, 30% equities, and 30% alternative investments, just to make it really simple. And the rest, let's call it, is in short-term cash or treasuries. Now, that I believe is a strategic long-term allocation for, let's just call it, a moderate risk profile. But based on what's going on in the world, what's going on in the economy, what's going on in the markets, what's going on with specific companies, what's going on with specific sponsors and managers of possible asset classes. Think, if you own private equity, Blackstone or KKR, that's really where you shift into tactical and tariffs, right? Or possible, the Russia-Ukraine war. Like, you maybe make small adjustments to your strategic allocation based on short-term tactical things that are happening in the world. But it's important that whatever you're doing, you have a short-term focus, but a long-term view on, okay, if you're going to go 5% less equities or 10%, whatever that number is, you ultimately know why you're doing that and when you may want to get back to what you view or what you've decided is your base case allocation. And the last thing on the last bullet, I think it's really important to understand. You'll see a lot, and I don't necessarily disagree with it, of folks saying, well, if you own the equity markets, they do 9% on average, which is absolutely the case. And hedge funds, depending on where you look, do 7 or 8%. So why would you ever own a hedge fund? And I think one of the things that you think about, and one of the reasons you allocate to different places, is while the S&P 500 has historically performed better than that hedge fund, or over the last 20 years, however you want to look at it, that comes within 18 to 20% standard deviation, meaning, within a certain band, you're going to really have big fluctuations, whereas the hedge fund that does 7 or 8% only fluctuates about 7 or 8% per year. So having different parts of the investment landscape in your portfolio will smooth out returns and ideally provide lack of correlation across your entire portfolio, so that when one bucket maybe underperforms, you have something else there that is ideally performing and holding up the portfolio. So I think that's I don't want to say a long-winded answer, but that does I hope a good job of describing how we think about asset allocation and some of the factors that you can see here that go into that decision.
Yeah, totally. And I think the simplest way, people talk about this all the time, is you don't want to put all your eggs in one basket, right? Is whether there's been, we've been relatively, I'd say, fortunate over probably the last 20, 25 years, but whether it's in early days of COVID, after 9/11, the tech bust in the 2000s, there's been a couple of these factors where, a lot of people say, hey, like the S&P has done, I don't remember the numbers, let's say 10% for the last 25 years, but there's been periods where it's dropped 20%. There's been significant downturns. And part of this is you don't know when you'll need liquidity, or you'll have opportunities to invest, or you may need money, and you don't want your entire portfolio to take that huge hit. And the part of whether it's hedge funds or commodities, they may not have the same average returns, but what you want things are that to this diversification balances each other out, so that if part of the reason people invest in commodities is the market's down, commodities have a very low correlation. You might know those numbers better than I do. But so the idea is you have something that's cash flow yielding or may perform better, so that if you need liquidity, you have something to sell off that's not down 30% or 40%. And so you don't leave yourself in effectively a distressed situation, which is the downside of concentration. So that's, and this is right. Like diversification tends to be a good thing. The more wealth you build up, right, is you're going to probably add these illiquid categories, and we can jump into those, and more diversification. Maybe you want to jump into kind of what are some of these kind of key categories and just, how to think about them and some of the trade-offs.
Yeah, I mean, this really is, I would say, that 30,000-foot view of the different types of asset classes that you're able to own. I think most people probably understand what equities are. It's stocks. That's Apple. That's Amazon. That's Microsoft. That's Google. Those are publicly traded. They have liquidity, and they fluctuate on a second by second when the market is open basis. So that is something that some view as a positive and others view as a negative, because when you log into wherever your account is, you can see at that exact moment how that part of the portfolio is performing. And that does, a lot of times, create anxiety. Fixed income are debt instruments. There's those span, the environment, the landscape of fixed income is much larger than that of equities. But you're owning some sort of debt instrument, whether that's of a government, maybe federal or municipal, of a company, whether that's public or private. There's a lot of different ways you can own debt instruments, but it's exactly generally what it sounds like. You are, in theory, owning that, taking away like a total return portfolio, you're owning that to get exactly what it says, fixed income, or collecting yield in some type of way. Real estate, to me, tends to fall into alternative investments, but that kind of depends on if you're doing, real estate investment portfolios through a sponsor, whether that's Brookfield or Blackstone or whoever that might be. But of course, there's private real estate that a lot of wealthy individuals own for a lot of different reasons. A lot of them, they have a lot of tax advantages, but it kind of sits between alternatives and fixed income, in the sense that in a lot of ways you do have some equity upside in that real estate, but in a lot of instances you are owning that to collect some yield. Within alternative investments, that tends to be all of the things that you don't see in the other buckets here. That's hedge funds, that's private equity, that's venture capital, that can be commodities, infrastructure. Those tend to be, when you think about that 30-30-30 portfolio, the parts of the portfolio that come with the most diversification versus the rest, but also, the lack of correlation. So you tend to want to add those to the portfolio to not only, ideally help the return, but also to lower the risk. And I don't think, a lot of people think of those investments as lowering the risk, but it obviously depends on what you're doing. A majority of alternative investments come with liquidity, different liquidity options, and a lot of times illiquidity. So that's something to keep in mind. And then cash and cash equivalents is exactly what it sounds like. That's money market, that's cash in a checking account, that's short-term treasury bonds that are readily accessible, pretty much whenever you need them. So this does a really good job of covering most of the different types of asset classes and the universe. Obviously, all these break down into subcategories. But
yeah, and I'd also say it's like, this is not necessarily structured this way, but the far left of these things tends to be more liquid. The far right tends to be more illiquid. And so it's like, as you have a higher wealth or longer time horizon, this starts to balance out more. Versus you need more liquid needs, you're probably going more equities, cash equivalents, and then you start shifting your kind of and evening out your portfolio as you want more risk or have a longer time horizon. Is that kind of a fair thing to say?
Yeah, I mean, it's absolutely the case.
Got it. Now this is kind of really, again, we started with kind of this idea of like asset allocation, and this is kind of asset allocation is how do you think about based on your risk, your time horizon, all these things, Max has mentioned. allocating between these categories. But then there's asset location of based on these and some of these same factors of which assets you invest in, but then also your time horizon, your liquidity needs, what tax you're solving for. There's the what entity holds these. So kind of as a quick piece, I guess, and just jumping to Peter, of maybe let's start with like there's a lot of these different structures out there, but we're going to focus on a couple. And really the idea is to give you an idea of some core structures as you're thinking about gift and estate planning, but also just how meaningful the combination of asset allocation and asset location can be. So there's more out there, but we're going to keep it focused on these.
Yeah, I mean, really, these are general categories that cover almost every trust that you would use in a really like basically any trust. There's a handful that don't quite fit in these categories, but this is pretty generally applicable. So there's two basic types of trust for income tax purposes. There's non-grantor trusts, which are treated as separate taxpayers for income tax purposes, and then there's grantor trusts, which are disregarded for income tax purposes. And so, if you set up a grantor trust, it's like sort of like having a single member LLC. If you have a revocable living trust, which a lot of people have, they're probably the most common trust in the United States. That's the type of grantor trust. But grantor trust can also be outside of your estate for estate tax purposes. And so the term intentionally a defective grantor trust basically just refers to a grantor trust that's outside of your estate for estate tax purposes. And so these are the two sort of basic types of trusts. Non-grantor trusts are useful particularly to people who live in high tax states like California or New York, New Jersey. If you live in one of those states that has a high income tax rate and you're a high bracket taxpayer, you can gift assets to a non-grantor trust for your kids, for example, and that trust won't pay state income tax, assuming it's set up in a low tax state, which it usually would be. It won't pay state income tax on whatever income it generates. So if the non-grantor trust is investing in private credit, for example, which is it throws off a lot of interest income, it's pretty tax inefficient. That taxable income won't be subject to your high state income tax. So that's non-grantor trusts. Intentionally defective grantor trusts don't have real income tax benefits since they're ignored for income tax purposes. But because they're outside of your state, but treated as part of your estate for income tax purposes, the IRS basically allows you to pay the trust income taxes without that being considered a gift. And so, if the trust is generating, $100,000 a year of income tax liability, you can actually pay that $100,000 of income tax liability without that being considered a gift that uses $100,000 of lifetime gift tax exemption. And so over time, the ability to make sort of annual gifts essentially to the trust by paying its taxes means that the trust is able to grow income tax free since you're paying the taxes. It's able to grow income tax free, which means that over time, more and more of your sort of larger net worth, including in trusts and personal assets, winds up being shifted into the trust. In the meantime, you're paying your portion of the taxes plus the trust portions of the taxes, which means that your personal rate of return on the assets that you own in your personal accounts, it's going to be a lot lower than the rate of return inside of the trust.
Yeah, and one of the things I want to call it here is like it's sometimes hard to understand it's funny is no matter how much time you spend in finance, compounding is still always surprises you over the long run. And with kind of IDGTs, the more worried you are about the gift and estate tax, or the farther over your exemption you are, the more valuable being the kind of, as Peter's calling it, being able to pay the taxes is that doesn't count as a gift. It may end up being your largest exemption or the largest factor you have in reducing your gift and estate taxes. And so it can be hard to conceptualize it, but if you're significantly over the lifetime gift exemption, this is probably the most meaningful way to reduce your estate's tax liability and maximize what you pass on to future generations. So it's a really kind of powerful piece there. So now we're going to kind of jump into, so these structures have different kind of benefits as Peter's talking through, but we'll talk about how do we conceptualize as to when you're thinking about the asset allocation you have, how does that fit within these structures? So maybe Peter want to start with kind of most basic level, everyone's kind of familiar with their own personal taxable accounts. What type of assets typically fit, like, or I guess what's the high level characteristics of assets that fit in there?
Well, so I guess I wouldn't start with the taxable accounts. I would start with the trust. So the basic framework is you want your higher return assets to be in trust, all else equal, because the trusts are outside of your estate for estate tax purposes. And so when you die, everything that you own in your taxable accounts going to be taxed at 40%. This is assuming you're over the estate tax exemption amount. Everything that you own is going to be taxed at least 40%, maybe 50% if you live in a state with an estate tax of its own, like New York, for example. And so, the dollars in the taxable accounts are worth 50 cents after tax for your heirs. The dollars in the non-grantor trust or intentionally defective grantor trust are worth a full dollar. And so all else equal, you want to get as much appreciation into those trusts as possible, which means that you want to put your higher returning assets into those trusts. So that's sort of number one, is you want to try to shift as much appreciation into those trusts as possible. And so a lot of times people invest in lower return assets in their taxable accounts and higher return assets in their irrevocable trusts. The other sort of big consideration, and there are a few, is liquidity. So obviously everyone's liquidity needs are different, but you don't want to put yourself in a situation where you're liquidity constrained because all of your cash flowing assets are in irrevocable trusts that you may or may not have great access to. And so, like, sort of the ideal asset for a taxable account would be like a bond portfolio, government bonds or something along those lines, because they generate liquidity. And so if you have any personal liquidity needs, they can help there. And they generally don't have super high returns. And so, you're keeping the relatively low return assets in your own name, and that frees up space for the higher return assets to be in trust.
Got it. So it's high. So it's the lower returning and more liquid assets is kind of what lends towards your personal accounts.
Yeah.
You mentioned that on the trust side, it's the higher returning assets. So that kind of leaves us with the intentionally defective grantor trust and non-grantor trust. So maybe how do you think about the difference between which assets you place in non-grantor trust versus intentionally defective grantor trust?
Well, so I would say a couple of things. So one is not everybody has both, and so you're not always choosing between them.
Yeah.
And it depends on what state the grantor lives in. So if the grantor lives in Florida, which is a no tax state, there's not going to be a lot of tax advantages of using a non-grantor trust in general. So non-grantor trust might not really make sense for any investments if you're in Florida, with the exception of QSBS eligible stock, which is like a pretty rare thing. But QSBS is a special type of stock. It's usually stock in a tech startup, and if it meets the various requirements under the tax code, you can actually get a $10 million exclusion of gain per taxpayer. So if there's $10 million of stock in some startup that you're going to sell and it qualifies for QSBS treatment, you can actually gift it to a non-grantor trust, and the non-grantor trust will qualify for its own $10 million exclusion. But other than that sort of narrow exception, in general, if you're in a low tax state, a non-grantor trust isn't going to make a ton of sense. If you're in a high tax state, a non-grantor trust can make a lot of sense, especially if you're younger and you're more focused on income tax savings, state income tax savings, and less focused on estate tax savings. The intentionally defective grantor trust is generally going to be the most overall tax efficient type of trust once you take into account both income tax and estate tax. Even if you live in a high income tax state, which means that the stuff in the IDGT is going to be subject to state income tax as well as federal income tax. The estate tax savings from using the grantor trust is in almost every assumption, almost every scenario, going to outweigh the savings from the state income tax savings from using the non-grantor trust. But in general, if you do live in a high tax state, both non-grantor trust and intentionally defective grantor trusts are pretty viable. It's sort of a question of how much you weigh estate tax savings, which are sort of more long-term, versus state income tax savings, which are more short-term.
Yeah. And I'm curious, Max, you have clients kind of in high tax states, low tax states. Do you see kind of the folks in this kind of high net worth segment that are worried about getting the state taxes? Do you see them have typically kind of more common to have these IDGT trusts or non-grantor trusts or combination?
I mean, I think as Peter alluded, like it depends on the net worth. But I tend to think that having both is better than just one of them. You're precluding yourself from optionality if you only really have one. You obviously see, I would say, more of the non-grantor generally. If there's one that someone's going to have, I mean, I'd be curious, Peter, as a ex-practicing, or as I say, a recovering trust and estate attorney, like which one you seem to do more often than not. Yeah, I mean, I think the best case is you have both. I think you tend to see the IDGTs as the, call it 300 or 400 level estate planning that people tend to do, where once they kind of have the non-grantor trust established, they then say, okay, well, what are other things that we're able to do? And the intentionally defective one is what comes next. Now, I'm not necessarily saying that's right. That's just kind of what it seems like in practice people do. Yeah, I mean, I think best case, you want both. But it just depends on the client situation. And in high tax states, I mean, they make obviously a big difference to have the ones where the taxpayer isn't paying the tax on it.
Yeah, it's a really good call. And there's a question here from Jason as to what's the difference between an IDGT and a dynasty trust. So IDGTs and non-grantor trusts are both typically dynasty trusts, which just means they're going to last for multiple generations or potentially for forever, depending on which state they're located in. Peter, anything else to kind of add there?
Yeah. I mean, there's sort of IDGT is like a income tax term, and dynasty trust is sort of a general term for trust that lasts a long time.
Yeah.
They're not mutually exclusive.
Yeah. And so, kind of, I'll pull both of these up, but maybe want to talk about kind of, there's of these structures of, for instance, why would you make more sense to put real estate on the non-grantor trust side versus ETFs on the IDGT side, and just kind of how you think about that logic. And, we're not going to go through all of these, but just what drives some of that and what's like the real benefits that someone's going to get. We'll obviously we'll get into the numbers after this, but maybe just how to think about this.
Yeah. So there's a lot of different asset types on this chart, but I'll mention a few of them. So one benefit of the IDGT is that there's usually a provision in there that allows you to swap assets out of the trust at some future point in time. And so without any capital gains realization event. And so let's say you fund a trust with cash or whatever when you're 40 years old, and that's invested in the stock market, and 50 years later there's I don't know, the public equities have have quintupled in value, and so they're super highly appreciated, which is great because it means you've shifted a lot of value to your children. But the problem is the assets in the trust are highly appreciated. So whenever your children in the future might want to sell some of that stock, there's going to be a capital gains hit, which isn't ideal. So what you can do in those situations is you can actually swap out that highly appreciated asset and bring that back into your own estate in return for a high basis asset like cash or bonds or something else. And so you get the high basis asset into the trust, and meanwhile you get the low basis asset into your estate. Why do you want the low basis asset into your personal estate? And the reason is when you die, all the assets that you own personally, not assets that are in your irrevocable trust, but assets that you own personally, get what's called a basis step up, which basically means that all of the capital gain is eliminated. And so if you can get that highly appreciated stock back into your estate, you can wipe out the capital gain by dying, and then your kids will inherit the stock and not have they'll be able to sell without capital gain tax liability. So that's the general idea. So the ability to swap assets out of the IDGT means that all else equal, it makes a lot of sense to have the sorts of assets that don't throw off a lot of income, but maybe appreciate a lot, grow in value a lot inside of the IDGT. Because if they're inside of a non-grantor trust, you're still getting the appreciation out of your estate, but you're not going to be able to do a swap. And so that capital gain is going to be sort of locked into the trust, and there's not going to be a way to benefit from the basis step up when you die.
Yeah, and this is kind of, in some sense, a full circle, right? Like Max, one of the things you started with calling out is, hey, you have diversification because you have different liquidity needs over different time horizons. And let's just say you don't even need a ton of money. But to Peter's point of, let's say you've done this and you've kept cash or government bonds in your personal name. Let's say you have a health issue later on in life. What you may want to do is swap that highly appreciated stocks that you've invested out of your IDGT into your personal name and move the cash out. And it's not because of the appreciation, but it's because of that basis step up. And so you're able to get the appreciation, over 10, 20 years, that stock is appreciated a ton. And that's happened outside of your estate. But then you're able to use that swap piece to get it into your, and so this is where you can help minimize the estate taxes by initially having it in the IDGT. And then for your heirs, help them avoid capital gains taxes when they inherit that. And so you're able to kind of stack these tax benefits on top of each other.
And I think it's also important as you go back to the strategic versus tactical. Asset location tends to almost fall a little bit in the tactical side of things, if I had to say, if it's strategic or tactical. But it's really important, I think, as you build out different types of asset location vehicles, whether that's trust, IRAs, personal accounts, to continue to make sure you think about the strategic allocation. I think there's a tendency for a lot of individuals to say, okay, well, this is the type of account that this is really what I need to have in this account, without making sure that whatever they're investing in falls within their overall allocation picture across all different types of locations that they have the ability to invest in. A lot of times you'll see too much overlap or not enough in specific areas because they're overthinking about, well, this type of trust, this is exactly what I should be investing in, but they tend to not invest in other things that they should have elsewhere. It's important to take a look at everything from once again, I keep using the term, but a 30,000 foot view of, well, how does everything look? Not just what does my IDGT look like versus my non-grantor trust.
Yeah, exactly. There's the micro and macro kind of optimizations. And at that high level, it's that asset allocation as to whether that's yearly or quarterly, whatever that right cadence is, you're figuring out, do I have the right balance for my needs, my time horizon, my risk profile? And then there's, okay, here's my portfolio. And simplifying it, let's say it's 20% across 5 categories. You may have your location for within the IDGT may be 90% of one of those categories. But you still want to keep to that 20-20-20 or whatever your holistic allocation is. And to just kind of give you guys an idea, really tee this up, but the idea of we want to take a couple of these for private credit and for public stocks, and just give an idea of if you put these things in a taxable account, a non-grantor trust, and IDGT, how do they perform over a time period, and what would your beneficiaries end up with? And Peter, want to kind of, I guess, give a little bit more context on the situation?
Yeah. So to give you a little bit more background. So first of all, like in general, these public equity returns look better than the private credit returns. That's just an artifact of the assumptions that we build into the model. It's not necessarily true that equity is going to be more efficient or higher ROI than private credit. That's just the assumptions that we use. So we're assuming that this person has a $20 million net worth when they fund the trust. The time that they fund the trust, they put $8 million into the trust in either the IDGT or non-grantor trust scenario. So in the IDGT scenario, they have $20 million and they're putting $8 million, keeping $12 million. In the non-grantor trust scenario, they're putting $8 million into the trust and keeping $12 million. In the taxable account scenario, they're not making gifts. We're using a 25-year time horizon. So these numbers represent the amount of assets that basically their heirs would inherit if they died in year 25. We're assuming New York City residency for the personal taxable accounts. We're assuming that the public equity is generating 1% annual dividends, which dividends are taxable, and then 9% annual sort of unrealized gains. And then we're assuming the private credit generates 10% annual cash flow with zero asset appreciation. And so because basically they're both generating 10% returns, but private credit is being taxed every year at ordinary income tax rates, while the stocks are being mostly avoiding tax in the short term, and aside from a little bit of dividend taxation. So basically what you see in both of these examples is IDGTs have the highest overall ROI, although in the non-grantor trust, in the public equity example, it's a little bit less dramatic. The private credit example, the difference between an IDGT and a non-grantor trust is pretty dramatic, just because you're paying a lot of income tax over those 25 years, and every income tax payment that you make is going to be is going to shift wealth essentially from your personal account into the trust account, and that's going to grow the trust and shrink your personal estate. And so when the estate tax is eventually levied, your personal estate is going to be very small. The trust is going to be very big, and so essentially the private credit inside of the trust is growing at 10% a year every year. The private credit in your personal name is growing at 10% a year, minus whatever your personal income tax liability is, minus the trust income tax liability. So it's probably like maybe a 2 or 3% return in the taxable account versus like a 10% return in the IDGT account.
Yeah, and I think, really there's a couple takeaways. One is, there's obviously the tax drag, or the amount that you're paying taxes annually really drives down the total returns from private credit. But again, that's separate from you. For diversification reasons, that doesn't mean you want 100% allocation to public equities, as we kind of chatted about. But it is also really important you want your highly appreciating assets outside of your state if you're worried about gift and estate taxes. And then also the difference, again, talking about public equity, Peter, you're saying it's close between the non-grantor trust and the IDGT here, but as you previously mentioned, because of that swap benefits and basis, this is like, it's hard to capture every kind of benefit here, but there's benefits beyond that $3 million delta that's captured here of putting it into an IDGT. But on the private credit side, it's a really distinct difference as to these high yield investments, if you're worried about gift and estate taxes, of leveraging an IDGT. There's a couple of questions here. One is from Robert is, on the previous slides, I guess this is, I think we were assuming these were all GST exempt trusts, correct, Peter?
Well, it doesn't matter in this example.
That's
So
true.
in this example, we're ignoring GST, but it's a good question. I think thinking about GST versus non-GST, I think if a trust is GST exempt, let's say you had two trusts, one was GST exempt and one was GST non-exempt, I would be shifting the higher return stuff into the GST exempt trust and the lower return stuff into the GST non-exempt stuff, GST non-exempt trust, setting aside, potential implications for, oftentimes the GST non-exempt beneficiaries are like your children, and the GST exempt trust beneficiaries are maybe your children and grandchildren and great-grandchildren. But setting aside sort of beneficiary considerations, I think you want to get the highest return assets into the most tax advantaged vehicles, which here are the GST exempt trusts.
Yeah, that's a really good call. Go through a couple more questions. Can agents hold assets with debt, or are we subject to?
Yeah, they're not going to be subject to the UBTI rules.
Yeah.
Like a typical legit. So the UBTI, in case for those of you who may not be familiar with the term, it's unrelated business taxable income, and it's a concept that applies to sort of charities and certain types of trusts that are charitable in nature. So like charitable remainder trust, for example, maybe a charitable lead trust, and private foundations and public charities and the like. And so basically charities aren't allowed to invest in operating businesses, and when they do, they pay UBTI tax on the operating income. But a regular intentionally defective grantor trust won't have UBTI issues.
Yeah. That's kind of, there's a question here as to how would PPLI and an ILIT private credit be better than this? The answer is it would probably be from a tax efficiency. I'm just going to share one thing here to just, if you want to kind of run these numbers, we obviously limited the kind of the number of things that we're comparing to make things a little bit simpler. But we have this tool, and we'll share this in an email afterwards and in the chat. But this is, if you want to, we have this estate comparison calculator where you can choose which structures you want to compare. We have more than what we talked about today. We have slats, ILITs, as Jason, you're bringing up, grats. And you can input, whether it's you or your client's age, where they live, their net worth, how much you're planning to gift, and kind of assumptions and growth rate. I have kind of the private credit assumptions here. And you can kind of see of what is the value kind of after taxes that your heirs are getting here. But then there's also, to this point of, to even proactively suggesting that an ILIT might make more sense here. So you can add that in, and you can see, to Jason, kind of one of the things you're potentially suggesting of the benefits of PPLI and an ILIT in this scenario. And this is kind of just a helpful way to, again, think about, as Max is talking about, there's the macro of what's your asset allocation and your strategy. And then how do you really get tactical of, hey, I'm putting it in this. What's the best way to get the most juice out of the private credit allocation that I have, and pieces like that. So that's kind of on those pieces. I'll say one last thing is just as we, wrong piece here. But I was going to say sorry about this. There we go. We really appreciate, I know we're running kind of on time, so I just want to say is, one, appreciate Max, you taking the time to join us. If you have questions or want to reach out to Max, ask any questions, you can reach him at maxsabert@ubs.com. You can also feel free to reach out to Peter or I to set up some time. And we'll also have kind of topics on, we have webinars weekly or bi-weekly on these different topics. And we'll share some of this recording and some of the kind of overview materials on these different structures and that calculator I mentioned afterwards. But one, really appreciate Max, you joining, and everyone taking the time to join us here. Hope this was helpful, and kind of will help people kind of really get the most value out of what you have and what you're passing on to your heirs in the future. So take care. Thanks, everyone.